All right, so let's start going through the ROIC tree for Royal Caribbean during this time period. Does anybody want to practice? Talk about the first level? 3 points at the first level? Because one of the things that you're going to be responsible for is not just the beginning and the end, but when you go through the group case, I expect the middle to be talked about as well. You got 10 minutes? So you need to also talk to me about the important trends between years 1 and 5. All right, so if we don't have any volunteers, we would have said for the end of year ROIC that in 2014 it was 5.7%. 5 years later it was 8.9. That's a 56% improvement in end of year ROIC, although most of it seemed to occur between 15 and 16 and 17. Okay, so again, I'm going to be sitting there grading you. What's going to be in the back of my mind? What happened in those middle couple years? What changed? All right, so that's some of the context that you should eventually be explaining to me. Now, 3 reasons. 1, tax rate. They don't pay any taxes. Right? Because even though Royal Caribbean has almost all their offices in Miami, they have a P.O. box somewhere, I think it's in the Bahamas, with like 20,000 other companies and some law firm, and that's their corporate headquarters. So basically, they don't pay any taxes because their headquarters is a P.O. box. By the way, you ever want to change our tax laws? This is the crazy shit that needs to be changed, right? But in any event, so they don't pay any taxes because they're not a U.S. company. Carnival's the same thing, okay, even though all their work's based out of Miami. So that obviously didn't affect their ROIC, so it's all pre-tax, which went from 2014 through 2018. Okay. Now, second and third driver, operating margin. Was it the operating margin or productivity that helped the pre-tax ROIC, or was it both? As you're looking at the data. Margin or ROIC? Or both? What do you think out there? The margin went from 11.7 to 20. Did that help or hurt? The ROIC. That should help a lot. Matter of fact, most of the margins started to improve between 15 and 16 when it went from 10.5 to 17.4. All right, so that's what I mean. Like clinically, it's easy to figure out the numbers and walk through. Make sure you walk through the numbers. Make sure you explain clinically how it's happening. But the other part is context. What happened between 15 and 16 that caused the big margin jump? I want to know. You should be able to figure that out. That's the other question that's probably going to come up when I say questions. I'm not going to ask you the not obvious question. That's a pretty big jump all of a sudden. Why was there a jump? Right? You should have some context to that. Now, productivity. Went from $2.05 to $2.24. So they're spending more, which is actually worse for productivity by 9.4%. So spending 24 cents more on invested capital was not enough to hurt the ROIC because the margin helped it more than the productivity worsening hurt it. That's your first level analysis. But again, there was a big jump between 17 and 18. 197, actually went down from 205 to 197, and then went up to 224. So why did it go back up after going down? Well, we get to our second level analysis. Gross margin, 96.4 to 99.7. Basically, it's a big fixed cost. So the way the accountants do this, there's not a lot of cost of goods sold, right? So really, it's an SG&A story, but nonetheless, 3 cents more gross margin. SG&A, 75.2 to 68.9. That was really the biggest driver of operating margin going up. And again, most of that happened primarily between 15 and 16. Where the SG&A went from 77 to 71. Depreciation stayed somewhere between 10 and 11 cents. So the real driver was a slight improvement in gross margin by 3 points and a drop at SG&A of about 6 or 7 points. That fueled the big rise in margins. Now on the productivity side, working capital went more negative. That actually helped them. PP&E to sales went from 225 to 247. Intangibles went from 8 to 3 and then to 14.5. So if I really want to see what happened, big jump in intangibles between 17 and 18. That was an acquisition. Who'd they buy? So second question is probably going to come at your teams if we were doing Royal Caribbean. First one would have been, why the big change in margin, particularly between 2015 and 2016? What really changed in their markets? And the second question I'm probably sitting there, I think in the back of my mind, is who'd they buy? Who'd they buy in 2018? Right? Because obviously they had a bunch of goodwill. So this is what I mean by you have to do the clinical walkthrough and you have to be prepared for the questions on your team. That's your ROIC tree walkthrough for Royal Caribbean. And by the way, that was about 5 minutes. Make sure you do both in the 10. Okay? CFI. What's going to be important about CFI? Start with the free cash flow. Again, you're not just talking about the total, you're also talking about the intervening 5 years. Okay? Start with the free cash flow, $2 billion. Free cash flow is positive for 4 of the 5 years, went big negative in 2018. Why? Well, one of the things we're going to see is in 2018, they spent $1.089 billion on goodwill. And they spent 134% reinvestment rate. That's what drove free cash flow negative in the final year. But that being said, over 5 years, $2 billion of free cash flow. Gross cash flow of $11.4 billion. Notice it went from 1.7 to 1.7 to 2.4 to 2.7 to 2.9. So generally increasing, particularly 16, 17, and 18. Investment rate 56, 69, 102, 7, 134. Right? Two things. Why was there a dip in 2007? That might be the third question. That might be crossing my mind. And then why the big splurge in 2018? Because obviously they're spending about 3-4 times CapEx versus depreciation. 4765 versus 1033, which is the 134% reinvestment rate. So that might be the fourth question that could come to one of your teams. So this is what I'm saying. I'm not going to ask you about the little things, but these would have been the 4 things that would jump into my mind if I was sitting there and listened to you. But these would be the things to start to point out as we talked about the 5 years. All right? Now, CFI went from $2 billion over 5 years to $1.5 billion. Now, obviously, it wasn't year by year the same. Some years, like 2017, they were generating a lot of CFI. 2018 went big negative. Why? Because in 2018, they basically had some kind of other adjustment, increase in non-operating assets. Right, to get to the 154 million, right? But really it was the, 51.7 to get to the 560. I'm looking at the total column, 560 increase, which basically took 2 billion, put a bunch, 560 million into non-operating assets, which ended up with CFI of $1.5 billion. So it's hard to see these numbers. Okay, what did they do with the cash? $1.5 billion of interest expense, borrowed $2.7 billion worth of debt. This seems like a recurring trend we're seeing in all these companies, to pay out $1.8 billion in dividends and $1.5 billion of share repurchase. So borrowing money to distribute cash to the shareholders. All right, relatively easy clinic. You can talk about the relatively consistent dividends and increases consistently over time, from 199 to 280 to 346 to 437 to 527. Share repurchases, a little bit more inconsistent because those tend to be discretionary, less so in the final year, and most of the share repurchase occurring in 2017. The biggest jump at negative 772. Right? So I might ask a question about why they did more, but probably not. That's not the type of question I'm probably going to hit you with, probably from one of the 4 first ones that would hit your team. Now, somebody asked a question in the first class. They said, well, gee, if I answered all the questions proactively, would you ask me any questions? And I'll tell you, like when I was here last week and Group Case 1, there was actually a team that did that. They did such a good job. I literally had nothing to ask them. I was struggling. I was like, is there anything I could ask them? I was like, no, they kind of covered everything. but that was 1 out of 26 teams, right? So I'm saying, like, if you proactively are covering this and use your 10 minutes, I don't need to ask you questions, right? But if you finish early and you're not covering this, I'm probably going to ask you questions. And if you don't cover stuff, that's also going to hurt your grade. So make sure you cover the whole CFI, make sure you cover the whole ROIC tree, make sure you're using numbers, and make sure that you're not just talking about the end, you're talking about some of the key trends in the middle. Do both levels of analysis for the ROIC tree, cover all 4 sections of CFI, right? Even if it's to say nothing changed in this section. Questions about either of the two? All right, so on Wednesday, we're going to practice some more in class. And I want you on Wednesday to practice yourselves. And as I said, by Wednesday, you'll know who the company is. So you'll have some time as a team to start working on that for next Wednesday, a week from Wednesday. So again, this Wednesday in class, hopefully we'll have a class. Backup plan is Zoom. But to talk through this assignment for Group Case 2, more practice. Following Monday, 1 week from today, you're taking the midterm exam. Right? Homework 6 is being postponed after you come back from spring break. Following Wednesday, you'll do Group Case 2, hopefully in class, 10 minutes per team. If not, over the web through Zoom, 10 minutes per team. And then you're on spring break, and then back here in 3 weeks, and then we'll start building the evaluation model. All right, stay safe, don't get sick. See everybody in a couple days.